Hello there, guys. Welcome to Talking About Finance. It's Sunday, June 6th. My name is Dave Coker, and you know what we're doing. 7 slides for 7 days. What me and my buddies were chatting about. Some of the stuff we were chatting about. We talk a lot, believe me. Various channels, social media, as well as Telegram, a couple other mechanisms. But let's talk about what's going on. Now, here's an interesting presentation. What we've got here is we've got the S&P 500. And we're going back to before the global financial crisis. You can see the sharp drop on the left-hand side there. And the subject is quantitative easing. And what my buddy's done is he's gone in and annotated the chart. Of course, we're looking at SPX and we can see the secular trend is like straight up. And that's something we've all been familiar with investing over the past decade or so. Just throw some money in the market, put it in an index fund. No need to pick stocks because everything's going up. Why? Pumping lots of money, but it's not straight line. It doesn't go in one direction. There are peaks and troughs. Let's take a look at it. The red arrows show the end of a quantitative easing phase or program, and then the green arrows show new quantitative easing. And the relationship is pretty clear, guys. You'll see at the market bottom, the green arrows, there's some new quantitative easing. In other words, a central bank is entering the market, trying to manipulate the market in a certain direction. And yeah, what a surprise. Market tends to go up at that point. It tends to perform pretty well. So that's a really interesting chart that we've got here. And you can see, guys, the outcome, or pardon me, the trend is in one direction. We're right in the middle of a program now. We haven't heard anything about the Fed cutting back. A little bit of talk about tapering, things like that, but nothing substantive yet. But the end of this program, when they do finish it, we're going to see the same inevitable result. The market's going to tend to perhaps drop down, the stock market at least. Still, we know that there's lots of different assets that we can trade. Oh, think of the bonds. Nobody thinks of the children or the bonds. And this is a good one. Now, we've talked about the bond market bubble before, the fact that in America at least, that fixed income government securities in a big bubble, absolutely incredible. And you've heard talk about record low interest rates. What I've got here is I've got the 10-year. We're going all the way back to 1985, and we're going up to the present. And check this out, guys, right? You can see the secular trend for bonds in terms of yield has been for the for the yield to go down. Think about what happens to price. And the curious question is, how long can this continue? Well, it's anyone's guess how long it can continue. I certainly don't know. But what will it lead to? Some people claim it's going to lead to a bout of deflation. I don't know. I'm not really sure about that. Could lead to inflation very easily. Here we've got something called sticky price, CPI. And we've been reading some crazy numbers reflecting price spikes in all sorts of stuff. I was reading about a $5,000 bike today, and it's not even a top of the line or a real Olympic class type of bike. It's just a bike, and you can pay $5,000 for it. It's really wild. So we're seeing all sorts of price spikes in stuff that people buy. And here's an interesting one, sticky price CPI. It's not your father's consumer price index or CPI. It's actually a subset of CPI. And there's goods and services that really don't change price too often because we can grab substitutes from other suppliers. So when we see the price of these items in sticky price CPI, when we see the price change, it is considered by some to be a more effective forecast of future period inflation. And we'll have to pay attention to that. It's really interesting that we saw two very sharp spikes in a relatively short period of time in the last 12 months. Other things that are going on. Yeah, guys, as we mentioned last week, the Wall Street Bets guys are back and they're badder than ever. And if you don't read that subreddit, Wall Street Bets, you really should take a look. I've been on it for years. It's very, very entertaining. And this is an interesting chart. Again, I didn't do this. One of my buddies did it. What we've got here, we're taking a look as of June 2nd, which was Wednesday, and we're looking at volume. We're looking at the turnover volume or the value of stocks traded. And AMC turned over about 38 billion. Absolutely incredible in terms of the amount of money, but that's a little abstract. To put it in context, let's take a look at Tesla. Let's take a look at Apple. Let's look at Amazon. They turned over 13 billion, 7 billion, or 6 billion, respectively. And it's actually amazing how much money is sloshing about in AMC. And this confirms something I've said many times. I don't think I mentioned it on this show, but I've definitely talked to my friends about it. I think there's a lot of professional money in the background. In other words, the Wall Street bet guys tend to get implicated. They take the blame or the credit when there's sharp movements. And I think there's a lot of professional traders. I know for sure, I've got some friends in funds. I know they look at Wall Street bets because we do talk about it. And I don't ask them what they're up to with their firm's money, but it wouldn't surprise me if they're trying to ride these waves when retail's moving in or maybe going against it. But still, it's really fascinating to see what's going on in the stock market here with the meme stocks. I haven't been tempted. Well, no, excuse me, that's a lie. I have been tempted, but I won't because I do read it. And, take a look at it today. You'll see what those guys are going to be up to tomorrow. I've been tempted, but I certainly wouldn't do it. I'm a different type of investor. I'm not a trader either. No, I tend to invest in, as I mentioned to you guys before, I invest only for cash flow. So it's interesting, guys, when you look at this. But regardless of what's going on in the stock market or the bond market or with inflation, we're always going to have Bitcoin, guys, right? And it's interesting because we know that there's a big drop that happened. And a lot of self-appointed experts and market pundits, Peter Schiff is famous for this, saying that it's over for Bitcoin and telling people that they should dump and get out. And I don't think so. We know the price has definitely fallen from its all-time high, but who cares? Just buy and hold. I'm certainly not selling any. And you know the story of me with Bitcoin. I bought every Friday night for many years, between 2012 and up to December of 2019. And then I stopped because I had too much at that price, or I had enough at that price. And then, of course, it had to go boom, boom up really high. It really distorted my portfolio in a major way in terms of percentages. But no, I'm not selling. But the interesting thing, guys, is that even though we saw it drop from its all-time high, we've got evidence here in this chart that the volatility is easing. And the black line is of interest here. We can see the spread or the difference between the daily high and the daily low is really down at a level we haven't seen, or since last year. It's getting down to its lowest level this year. So if you're inclined to buy, guys, in any case, just buy and just hold. And even if there's another explosive gap up, which there will be, I'm pretty confident, just hold. That's what I'm doing, and that's worked out well for me. And it could work out really well for you guys. And then, when you need to sell because you want to buy something, you'll have you'll have a good profit to trade against, and maybe you'll buy a car. Americans love their cars. And in the States, we're seeing total vehicle sales really start to explode. Speaking of explosions with Bitcoin and things like that. And this is wild because we can see, I'm looking at total vehicle sales here off the wonderful Fred site. And you can actually go in and graph this as well. And we can see in April 2021, there was almost 110% year-on-year increase in car sales. Absolutely amazing. To see anything similar, we have to go all the way back to 1985 when there was a 37% gap up in price over that period. Really wild. So in any case, what are you going to do with your money, guys? Well, yeah, you got to be putting money in the market. You just got to be very tactical and just pay attention to what's going on. For the longest time, growth was a good destination. Now it seems that value has been coming back into vogue. And what I've got here is I've calculated the quotient of the Dow Jones Growth Index and the Dow Jones Value Index. So it's Dow Jones Growth Index divided by Dow Jones Value Index off the wonderful stockcharts.com. You can duplicate this yourself. And I'm going back 5 years. And you can see for that period of time, from 2016, growth was favored. But something changed. And now we're seeing a switch out. And this is classic type of behavior. Investors tend to cycle in and cycle out. And now we're seeing that value is coming back into vogue. And I don't know, think about it when it comes time for your own investments, guys. What are you going to do with the money? All right, guys, that's it for today. Hope you enjoyed it. Hope you found it useful. Once again, it's Talking About Finance. My name is Dave Coker. You're going to have a wonderful week. I think the equity markets are going to explode in a good way this week. And I'm certainly not selling any stocks. In fact, I was telling my family, I haven't been this active in the stock market in, probably a decade. I've been buying stocks pretty much every day last week. And I might continue it this week. I've got a couple plays that I'm looking at. So once again, make sure you put the money in the market. You leave it there, you'll get richer. All right, guys, take care.